So I think the way I would like to do this is I'm going to ask them each a question and introduce them, and then I'll turn it over to you guys to ask questions. And some of the questions that I think came up on the diligence list, as well as from the first half of the class, I think we've got some experts to choose from. And I'm going to start with Jim Southern. Raise your hand, Jim. So Jim and I have known each other for 20 plus years. I mean, a very, very long time.
Before you started shaving.
When you still had hair. Jim was my Jim was actually my second investor in my whole life when I raised my first search fund. And since then, I have invested in deals that Jim had, and Jim has invested in deals that I did, and he's been on my board, and I've been on his board. And that's all well and good, and we've made money together, and we've lost money together. But the best part is that somewhere along the way, the business relationship became unimportant, and it just became a friendship. So I'd like to introduce Jim as my friend. Let me ask you the first question. How have you seen searchers handle this whole issue of identifying whether a person is a seller or not?
So I've seen it handled well, and I've seen it handled poorly. I think it's important that you learn to get a deal flow going, but to learn how to get on and off a deal, because it's going to be the velocity with which you move from deal to deal that determines kind of the probability that you're going to get a business bought in your search. Some people will not even go out to visit someone unless they have revenue and EBITDA, maybe in the form of just a telephone conversation from the seller, or possibly in the form of financial statements. And only then will he go out and visit them if they have some general range of agreement on price. That works pretty well, but you need to have a huge deal flow, which it might work for you guys because you were seeing so many companies. If your deal flow is not so big, you're more likely to handle it poorly, and you're going to go see people that really don't want to show you their financial statements. They don't want to talk about price. They tell you about their friend who got 7 times EBIT or something a couple of years ago. And you can just end up spending a lot of time and money and drying up the rest of your pipeline in the process.
Thanks. Rich Kelley. Rich started Search Fund Partners, how many years ago?
7.
7 years ago, and is a graduate here at the business school. And we've actually never met, although we've seen each other's names on the bottom of documents many, many, many times. And I think the best thing that speaks towards Rich and Search Fund Partners is the number of times people say, oh, have you talked to Search Fund Partners? They seem to be on everybody's A list. And it's easy to get on the investor A list when you have no reputation. But after you've done a lot of deals and had to sort of conduct yourself both in good deals and bad deals and tough deals and easy deals, you start to build a reputation for who you really are. And Search Fund Partners has endured all that and stayed on everybody's A-list. So it's just really a pleasure to have you here. Rich, can you maybe address the issue of to what extent searchers have been able to effectively use their investors to gain credibility when somebody asks effectively, how do I know you can buy this company?
Yes, it's always a bit of a shell game when you're a searcher, because anybody worth their salt is going to look at most freshly minted MBAs as being more air and less, all hat and no cattle. And there's a whole bunch of techniques, but the first thing you got to remember is that the search fund model itself is really gathering momentum just on its own. And so many, many business brokers now are very familiar with it. 10 years ago, 5 years ago, that wasn't the case. And so you're catching a wave there that's good. It's becoming well known. People understand the kind of two-tiered search mechanism. Websites are so easy to put up. You've got the investors' backgrounds. I'd put a bio in for each one so that somebody can Google onto them, then Google onto all the way through into the investor pool. And then lastly, have a go-to list of 2 or 3 investors that are used to the kind of requests where they can actually talk directly to the seller if the seller wants some verification that there are people behind this guy. We've sent letters certifying that we are investors in this thing and that we're willing to look at every deal. We never stretch it to say we're definitely going to invest, but you can get credibility just with a letter or a phone call. And then oftentimes that actually evolves into a meeting, because we want to get involved in the due diligence as quickly as possible if we can. And if we can meet the seller early on and help convince them that we're real and the money behind the searcher is real, that's helpful.
Rich, so when you get a call from a seller or you're in a meeting with a seller and you're not committed to the deal, how do you answer that question if they ask you over the phone or directly, is Search Fund Partners prepared to do this deal?
We're pretty frank about it. We say, we've been working with this team for a year and a half. We've looked at 7 deals with them. We also work with 10 other searchers. We've invested in every deal that got past a certain stage in negotiations. You're not quite there yet, but we follow up with what we say, and that's who we are.
Okay, great. Rafael Somoza, but nobody calls him that. Everybody calls him Pochito. We met 10 years ago, probably, when
More, 96.
96, when he and a partner, Jose Stella, bought a billboard company in Puerto Rico. And I think you heard Bill Egan say, or I quoted Bill Egan as saying that he only had 2 kinds of investments, those he had too much of and those he didn't have enough of. And as soon as I invested with Pochito and his partner and I was on the board there, I knew right away I didn't have enough. And it certainly turned out to be the case. And since then, they've sold their business and they made a lot of money for people. And now you've been active investors both in search funds and direct investing. The question I had for you is that the issue of non-competes came up. And I was wondering if you had some thoughts about how you guys, if at all, had to handle non-compete agreements and non-disclosure agreements.
Actually, yes. The reason partly why I'm sitting here is because we said no to a non-compete clause that they wanted to put in one of our agreements. It was actually the billboard industry. We were trying to buy, we ended up starting actually, not buying. And we were looking at a company and the owner said, well, that's fine. We want to include a non-compete in the confidentiality. We basically said, look, we were very open and frank and said, look, we're looking at this industry. We're going to enter with or without you. Ideally, we will buy your company. But if we're not able to reach an agreement, we want to let you know that we might end up buying someone else. Thank God his lawyer was present there and that got stricken out. Eventually, when we started the company, he tried suing us, and we basically referred to our old agreements, which said, the non-compete was stricken out, and that was the end of it. So, I mean, that was something that is very important. You should never do. Ideally, there are ways that I think. Who was it, Mike? You mentioned their non-solicitation for employees. That's a way of trying to make the seller feel a little bit more comfortable. In terms of the confidentiality agreements, one of the things we did, and I think this goes with building trust, what many of you brought up, we always were the ones bringing that forth day one. After the first meeting, said, look, if you're interested in discussing this, obviously there will have to be exchange of information. What we propose so that you feel comfortable is we sign a confidentiality agreement, and that way you'll be protected and we'll be protected. And I think that immediately when we took the first step in saying that, that sort of lowered the defenses of the seller and made them feel a little bit more comfortable.
Good. By the way, just to digress, Jim, you've invested in how many deals, roughly?
45 search funds, probably 23 active acquisitions.
And your estimated IRR is?
Don't know the IRR. It's been about 13x cash on cash.
Okay, so it's a very good record. And Jim will have all these reasons why he's done so well, but the real reason is he's got a really good investment committee, including his wife, Linda Southern. So I'd like to welcome Linda Southern. That is the power behind the throne.
That's right.
Robert, you were generous with all the information about the logistics of your search and how you managed it and your time and so forth. I'm wondering if you would just go to a completely different place and maybe comment a little bit about what it was like personally and some of the personal challenges that you faced during the search.
Absolutely. The thing that we sort of realized about 2 months into the deal is we'd gone through this, happy stage, and all of a sudden we're very, very sad. And it correlated with, you find a deal, it's very exciting, and then for some reason or another, it doesn't make the cut. And every deal that you look at as a search funder is the deal until you actually close the deal. So every one of those was that much more important to us, and we were fully emotionally invested in it. We were fortunate that we had a team. So when it came to being lonely, I mean, I spoke to Mark more than I spoke to my wife, and we happened to be in different cities. We talked all the time because you need a lot of support. Cold calling is not easy. There's a lot of rejection you have to handle. It's like being in sales all over again for those who've been in sales. It's probably a lot more taxing than we anticipate. The good news is about 2 months into it, you figure it out and you adjust. And so, going into a search, even if I tell you about it, the first 2 months are going to be brutal on the emotional side. It's just the way it is because it's a very, very solo exercise, even if you have a teammate.
Rich?
I have a nice antidote to that. I have not done a search. I've just been an investor. But we have a annual gathering of all of our searchers and all of our company operators. And the first year we did it, we had 8 searchers and 1 guy that had bought a company. So the agenda was obviously slanted toward tactics for the search fund. The next year, 7 people had found businesses, and there was still 1 guy searching. And so we kind of flip-flopped the agenda and started with a very small program for the talk about the search thing. We never got to the operational questions because the guys who had bought businesses and were facing daily challenges, all they wanted to talk about was the search fund. And it was like a group therapy exercise. We just kind of stood back, and it was clearly one of the most emotional times of their life. And this was a group of people who had all done the same thing, and they just wanted to talk. It was amazing.
I remember I do remember the first day of my search, and it was something like I got the fund closed, and I really remember sort of sitting at my desk and kind of like moving the pencil over there and then sharpening it again and waiting for the phone to ring. And we didn't have all the software. All right, so let me turn it over to you guys. And Jason, you had a, what's that?
CRM, what?
Yeah, exactly. Jason, you had a question which we were going to put off until this panel.
Yeah, well, actually, to be honest, I feel like Robert addressed it pretty well, but
Okay.
I'll use this opportunity to ask another question.
Yep.
So actually, going back to David's comment about risk before address failure, and in particular, what is the perception of search funders who have failed, both people who failed to find a deal over those 2 years, or people who did find a deal and failed afterwards? And I think we all acknowledge that the latter is much worse. And in particular, could you relate that perception of failure to those who fail starting their own businesses? Is it considered sort of better or worse to fail when you do sort of a traditional startup on your own versus failing in this scenario?
Jim, would you take that?
So Lisa, do I have to repeat that question? Oh, you got it on. So I think to raise a search fund, spend 2 years searching, and fail to find a business and close the search fund down is a feather in your cap. It is not failure. If you choose your investors carefully, they knew the risk they were taking going in, and assuming they've done more than one search fund, they know that they get a step up on the search dollars and other deals to compensate them for taking the search risk. And I just can't see why. Well, I suppose someone might harbor ill feelings towards you, but it doesn't make any logical sense for them to have that. Furthermore, outside of the people that backed you, I think you'll find that they are amazed that you tried that, and that they'll view that as a source of strength, and it'll be quite easy for you to go back and get into the career path line that you might have pursued straight out of business school. The other part of your question was by the business.
Well, then okay, so what happens, what's the perception if you fail when you do buy a business? And also, how does that compare to failing on a traditional startup?
It depends on how you fail after you buy. Once you buy a business, I think it depends on how you fail. If you failed just making bad judgment calls after bad judgment calls, I think your reputation as an operator is going to be soiled. If you get out there in 2 or 3 years and go to your investor group and say, I think we bought a dog company, or we picked the wrong industry, and you choose to get out before your reputation is sealed in some other way, I think you're probably in better shape. to the correlation to doing a startup, I don't think there is any comparison between the risk of doing a startup and the risk of raising a search fund and finding and buying a business and succeeding. In the universe of companies that I have, where I've actually made an investment in the acquisition, 75% of them have had positive outcomes, and only a quarter of them have lost some or all of the investor money. And I just, the startup business is just, maybe it's 1 in 10 or 1 in 20 that succeed.
Pachito, you had something you wanted to add?
Yeah, I got lucky. I think in terms of failing to find a company, many times the reason why people will fail was simply not because they didn't do their work or were incompetent, but because they had the discipline not to do a bad deal. And I think that shows a lot. In the end, if you run through your fund and the reason why you didn't do it was because you couldn't find a suitable target, which is a lot better than buying a company for the sake of buying a company.
I'd add, Jim and I have both done bad deals in our careers and had to manage a company that was in trouble. And I think Jim, I know that Jim would agree with this, is that there are a few things in your business life that are more miserable than running a company that you shouldn't have bought in the first place, because there are no easy exits in a bad situation. And that was one of the points that both Bill and Will Thorndike made, which is it's not failure to not get a deal done in your search fund. The failure is to rush to judgment on a company to get a deal done because you think that's the mark of success, and then you've really put yourself in a tough situation. I don't know if you want to add anything to that, and then Rich, Jim.
No, I think it's very difficult to recognize that you're buying a bad company in a bad industry, at least from the search funder standpoint, because you're so invested in the deal. And hopefully, you're surrounded by wise directors and investors who will say, "Wait a minute, Jim, this is a bad idea." Unfortunately for me, it was my second company that was the bad deal, and I think my we had a great outcome in the first one, and I think my investors imbued me with skills and characteristics and capabilities that I didn't have, and concluded, all of us incorrectly, that I would succeed in what most of us thought was a crummy industry. And so, the only lesson I learned from that is just look at good industries with the wind at your back and good solid companies within those industries, and you should be okay.
Rich?
Yeah, the one last little tidbit I would add about if you're running a business and it turns out to be a failure, a whole lot of how you end up walking away from that business in terms of your reputation, and I think your momentum going forward is how you and your investors work together. Do not try to be a hero and sail through the wall. Work with your investors, make sure all of the big decisions are made in conjunction with your investors, because they're part of the deal, and these are small businesses. It's kind of an informal corporate structure, and they shouldn't want you out there flying solo.
Questions? Victor?
Question is actually Mr. Befidi. I wonder if you could comment on what's the biggest surprise since you acquired your company, your business in 2008, that you wish, maybe you would have done the deal, but once you walked in the door as an operator, what's been, one of the biggest things that you
Biggest surprise since we acquired the company, managing human capital. So we bought a business that was in the secondary market, away from a large metroplex, and as a result of that, we inherited a lot of employees who are very, very loyal. You can imagine that a lot of these businesses are going to be lifestyle operated businesses, which means they work a certain way, but the goal isn't really aggressive growth. The goal is more sort of a social well-being type community feeling in infrastructure. And a lot of what we've been trying to do has been geared more towards growing the business, which really puts a lot of strain on people's work experience in terms of what we expect from them. And that is proven to be, in most M&A deals you get into this issue, but that's proven to be probably the biggest surprise in terms of what it takes to get people. So you get them on board, but to keep them on board, it's a lot of effort. So, all the hard work on the financial side, all the hard work on the customer side, you can't forget the hard work of managing your people and rewarding them. And it's probably one of the fewest attended class in B school is the one of managing people at work, which is ironic, but yeah, that's been the challenge.
AJ.
Question for Pachito. How did you decide to build versus buy, and how thinking went into that process?
I think there's a little bit of what Dave said about being creative in your search. I think we got to the point where our deal took us, I think, roughly 3 years. I got to the point where we had looked. Ours was a geographic search in Puerto Rico. We had looked under almost every single rock for a company that we weren't sure in the end if it existed down there. And we had looked at the billboard industry, liked it, tried to buy, couldn't do it because of diligence reasons. But we had done a lot of diligence in the industry, talked to a lot of people. We liked, I think Jim pointed something out which we're strong believers, also, and it's been the case in our second time around, picking industries with high growth and winning your back. And we saw an undermanaged, underdeveloped, underpenetrated industry. And we began asking ourselves a simple question. If we were gonna buy, I think it was gonna pay $10 million for a company that had been in existence for 3 years, we looked at the industry we saw was growing very rapidly, and we looked at ourselves and say, well, why can't we just start something from scratch? And it sort of evolved from there. We sort of made the list of things that we needed to ascertain in terms of validating the execution and try to limit the startup risk to merely an executional risk. We knew there wasn't a business model risk. It was merely, could we go out and execute? In the case of billboards, could you get the sites? Could you get the permits? Could you get the sales? And we did proof of concept, and we had a very disciplined approach to it, and probably spent 6 months doing that, and up to the point where we realized that we felt comfortable that we could do it. But I think key there also was, and I think some people mentioned it, investor communication. We had sold the investors on the industry. And actually, it was funny in a way that several of them said, look, why not start if you can't buy? So it was sort of, we all collectively reached the same conclusion. And I think that's something that I've always told search funders, look, if you find an industry that you truly think it's a great industry and you can't buy in it, at least ask yourself the question, can you start something in it? I think there's been several examples of that in the search fund community. It's not the traditional way, and I'm not advocating that you go that way, but it's something that at least you should have it in the back of your minds.
And wouldn't it be true also, Pachito, that your startup model fit with the capital structure that is sort of implicit in a search fund in terms of the amount of money you need to raise and the way it's raised? So there would be some startups that the way the capital would flow would be contrary to a search fund.
Yeah, I mean, it was. We raised $3 million. It was staged, and I think where the deal fit the search fund model in the end, it wasn't. We weren't talking about a new technology. We weren't talking about a new business model. I mean, nobody questioned whether you could actually make money in billboards. The question was, could we execute our billboard business plan in Puerto Rico? So I think that's the reason why it fit the business model. It wasn't something as we want to do a new technology startup within the search fund model. It was a proven business model.
Ogden Nash had that poem, I think that I shall never see a billboard lovely as a tree. Indeed, unless the billboards fall, I'll never see a tree at all.
We're now doing cell towers, so it's very...
Exactly. Yeah.
So when you buy a business and become a CEO, what ideal relationships you want to build with the second level management? How do you do it? What was the biggest mistake you've done, and what was the most successful thing you've done?
Well, for us, buying our business was all about the founder retiring. So, building rapport with the management team was key, and something we continue to work on very aggressively. In terms of mistakes you make, I think, as I described earlier, how we worked, our pace of work is significantly faster than most people's, and it took us a while to slow down to their pace, because you have to realize if you don't adapt to the business, you are not going to let the business sort of welcome you and grow with you. So it's more of you adapting to the business, and then from that point shifting, than really coming in and pulling the business, because then you're going to be working alone the whole time.
If I wanted to add to that. I think that most of us here are accustomed to working with very similarly minded people with very similar work ethics, very similar intellect, etc. And it's very different when you go to either a startup company in the industry that we chose or acquiring a company, where you have to realize that not everyone is like you. And not everyone can work at the pace that you do. Not everyone will answer an email at 10 o'clock at night. Not everyone will put in the time that you normally put in. So, I mean, that for us was a big shock and something that gets some time to get adjusted to. And you have to be careful not to push so fast that you'll make the system collapse.
Rich?
I think following on to that, you have to understand that within 18 months, you're probably going to have an entirely different team because you just weren't able to get those folks up to the level that you wanted to. There may be one keeper in the sales department that has got all the relationships, but it's inevitably taking it to the level you want to get it to is going to require almost a complete changeover. And your question is how to do it gracefully and honestly.
Yeah.
And I guess, sorry for follow-up, but given this, I mean, how do you position yourself at the very beginning? Okay, day one, or I don't know, week one. So what message do you give these people?
You tell them why you're excited about the company. You tell them, why you bought the business, and you tell them what your vision is for the company. And I think everybody realizes, at least you make sure everybody realizes that this is our vision today, and everything. So what we did is we showed up and we had a communication plan for transitioning, and we had communication going to the customers. We had things that the seller would say to the customers, say to the employees, and then we flew the next day to meet and sort of introduce ourselves. And ultimately, what we told everyone was everything we've learned about the business, we're going to throw out the window, and we're going to meet with every single one of you to learn it all over again. And that's what we did. So we went on the 90-day plan where we pretty much re-explored the entire company and came out with a list of 130 or so critical initiatives that were 95% through a year later. So it took a while to get through them, but that's how we approached it.
Why am I not surprised you had 130 critical initiatives? Okay, Aaron?
How sticky have you all found sellers' expectations regarding price? In the case of mentioned, it said, well, we've all seen deals for 4 or 5 times revenue. If you know, A, that's more than you can pay, and probably B, more than what the industry comps have gone. You've been able to talk sellers down off those things, or what's the gut in their head?
Jim, would you take that?
My rule of thumb is don't waste time on the non-believers. If they've got unreasonable price expectations, your job is to have a pipeline of deals and just go on to the next deal. And maybe you dance around with them, one song, but if it doesn't go someplace after that, just drop them nicely, and you might call them back in 6 months or 3 months, but get your deal flow velocity up and get on to the next deal.
And I'd say if their expectation is within 2 times where you think you want to be, you can handle that with structure. So that's not a problem. But if it's beyond that, then it is tougher to do.
Ryan?
All the searches that you've collectively seen, have you ever run into an issue when the due diligence begins in earnest that you find yourself competing against one of the management team to buy the company? That once the management team finds out the company's for sale, they themselves actually go in.
Rich, you might have seen something like that.
No, I've never seen that.
That happened to us on one deal, which is proprietary. They ended up buying it.
The manager,
So the founder was actually my neighbor's son. And we spoke to him about his company, and the management team found out that he was interested in exiting, and they bought it from him.
I say, Ryan, a question that I would always ask in an auction situation is if management is bidding. And if management is bidding, I think that you have to recognize that you may be just pricing the deal for somebody else and that they have a huge advantage over you. So, Matt or Mike?
So from an investor standpoint, thinking back on the 50/50 side of action that people decide to pass on,
What have been some of the key differentiators?
You know, it's really not easy. A lot of investors, search fund investors, agonize over meeting a prospective search funder, and they call people and say, "What do you think about this guy, and or gal?" And they end up doing one or two, back in one or two searches a year. I don't see how in a 45-minute meeting with you or anybody else, or maybe even two 45-minute meetings over the course of 2 or 3 weeks, that I can decide that you're not a winner. And what I can do is I can pick up on it. Is there anything about you that makes me feel uncomfortable with your integrity? Are there any things about your terms that would indicate that you're pushing the envelope, like you're going to pay yourself $140,000 a year, and you want convertible preferred in the final structure, stuff like that. I can look for those things, but basically, who am I to say you're not going to be a great success? And I've always been pleasantly surprised, and so.
What percent of the deals, Jim, that you've invested in, the percentage of the search funds that you've invested in that come to you eventually for a deal where there's real capital, what percent of those deals do you think you do?
I think it's probably around 65% to 70%.
Rich, you were smiling at some point in that answer.
Yeah, there's a lot to smile about in that question. First of all, answering that question on our part, we've invested so far in every deal that has actually made it to our desk that was a real deal. We don't think that's entirely coincidental, because we're pretty active in the search stage, and if somebody's going a place we aren't comfortable, when we signal that, and that may have something to do with why a deal didn't get done. But the other thing I was just smiling about was thinking that when we first started doing this full time and started meeting a lot of searchers, we would agonize, like Jim was saying, about, geez, this way, this guy. Pretty quickly, we got to the point where realizing that serendipity is just a huge factor in this. And we got comfortable with that. There is something to that. And it's why it's a valuable thing for investors to have that optionality. It's like, I'm investing in you because you're going to work hard, and I'm going to get to see what you produce in 2 years, and then I can decide whether I'm going to put serious money into the deal. I'm going to know you. I'm going to know how you work. And then the other thing that I laugh at is that there's a serial investor who's done a lot of these over 25 years, and he's tried to be incredibly systematic about trying to predict whether or not somebody has what it takes to be successful or not. And he has the searchers do a battery of tests, and they're these kind of Myers-Briggs type tests. He abandoned ship a couple years ago. He's like, there's no correlation.
There's not.
Did you have your hand up, Sandy?
I didn't.
Oh, okay, all right.
Other than representing kind of the strength to acquire the company, what are some techniques searchers can use to leverage the experience and backgrounds of their investors, and kind of how should you consider that when putting together your investor base?
I'll take a first stab at that one. We followed a fairly structured approach for that. Given we thought about industries that we wanted to target, and we tried to have different people with different backgrounds in our investor base. So we wanted to have operators. We wanted to have people with distribution expertise or manufacturing expertise. We wanted to have entrepreneurs. We wanted to have private equity guys. Ideally, so that each one would contribute something differently to the mix. So that's one. Two, in terms of leveraging them, I think the quarterly reports, at least for me as an investor now, and also thinking about when I did this, they were a way of letting people know what we were looking at in such a way that I could try to elicit response in terms of, yes, I know that industry well, be careful with X, Y, Z, or you should talk to my friend Peter in X company. And I think that for us was really helpful, and I think it's very helpful for people who do it. If you're able to leverage your investor base in terms of deals that they've done, contacts that they have, introductions that they can provide, pitfalls, valuations, I mean, a number of different things that they can be really helpful with.
I would second what he said. The one thing we also did is we picked people who we knew could help us post-acquisition from a leadership standpoint. So one of our smaller investors is actually someone who was a CEO for 30 years, happened to mentor 8 other CEOs in that time period. And he told us, I can't do $1 million, but I'd be interested in doing something small. And we told him what we really wanted from him was the ability to keep him engaged and to be able to tap into his knowledge on the operations side. And he's on our board today as a result of that. So it's really up to you how you manage it.
The other thing you need to think about in assembling your investor base is just, you need to try to hypothetically think about what their possible depth of pockets is.
Yeah.
These days, it's a different world than it was 4 or 5 years ago. Now, everybody needs deep pockets because the capital markets are so stretched. You should actually consider your search fund group as your first line of investors, and then you should have a second line of investors that you are almost certain will participate. But you want to have people that can write bigger checks in your fund as long if there's a gap.
Yeah.
I have a question for you. Given you just completed the search like about 1 year ago, was there, in the 5 companies you found out, was there an industry theme, or were they pretty much across industries when you did the LOIs process?
Oh, we were very, very targeted in what we're looking for. Sticky B2B types, transactional, forgiving businesses, meaning, I lose one client, I don't go belly up as a result of it. And so, ironically, actually, every company we looked at had underlying a technology play where we could add value by capturing efficiencies based on what we could bootstrap ourselves. But they were all B2B transactional type companies.
Ryan, you got a question?
Yeah, Robert, so you just finished off your search about a year ago. I was kind of wondering, what happens to, especially everything you had in the presentation, it seems like a ton of work, and now you move on to an operating role.
We've had all these ideas about how to make that resilient over time. The reality is you're so busy that you don't get to it at all. I mean, the data is in spreadsheets. I had to get to a different computer to get them all put together over the weekend. It's there, but the other thing you have to keep in mind is people move, right? So probably 75% of those contacts are no longer valid because those were accumulated in 2007. They've all changed jobs now. That's just the reality of it.
Jesse?
A little bit back to a previous question. So if you could find really wealthy investors, say, Carlos Slim, say, Warren, if you find
You want both of them in the mix. We have both of them in the mix. It's important that you have both of them in the mix. Otherwise, you're going to have a tough time.
Jim, what have you seen in investor profiles?
I guess in talking to the search funders that search fund entrepreneurs that I'm invested in, there's kind of a common theme that they're surprised at how little help they get from their investors. And when you think about it, if Search Fund A calls me about a really great niche in the widget service industry, if I then relay that conversation to Search Fund B, I am dead meat. So I can't be a funnel of information, for starters. Another type of investor is just really busy, and he can't stop and take every phone call. And also, investors by and large are not deal sources. They're just not. They don't have a source of deals coming through their shop that they can give to you because they act on them themselves.
And Jesse, I would add to that I think whether your investor was the richest man in the world or a mortal with $50 million, you're sort of starting with a situation where you want the search fund piece of their investment pie to probably be in the 5 to 20% category of their total investments. And then within that, maybe they have 5 to 20 search fund investments. So I would say that your problem is not that you're going to reach their upper limit with your search fund, because if they're investing $20,000 or $30,000 in the search fund, they're hoping that you bring a deal that allows them to put $300,000 or $500,000 of capital to work. So that search fund investment is almost insignificant to any of the search fund investors. They're just thinking about the option. And it's not an irrational thing for them to completely ignore you for 24 months until you bring a deal, because they don't have anything at work yet. I don't know, would that?
Yeah, you summed up exactly what I was going to say. We really pride ourselves on our interactivity with the searchers during the search phase. But
Which is rare compared to the individual investors,
but
right?
Truth be told, we just don't get it the same way you do, because it's a digital world for you. You're a 0-1 option, and we've got many, many options. And I might encourage you to go do something that's got a little wild hair up it, because to me, that adds to my portfolio. To you, it puts you out on the edge living dangerously. And so it's a fine line.
Yeah, one last question?
Maybe one from investors. Maybe you could just comment on the current fundraising environment, just kind of your personal appetite for investing right now, and how that maybe compares to previous years and looking forward, just your general views on the market.
Pachito, why don't you take that since you're on the investor side now?
I think it varies by who you talk to, but I think the part of the key here, if you're a new search funder, I think you need to start looking outside of the traditional sources of capital, just because there's so many of them that several or many people already tapped out or have a lot of active searches going on right now. So I think it'd be wise to try to broaden the scope and try to grow the investor base that looks at these types of deals. But we're seeing a lot of increased interest from a lot of people who want to do this. On our end, we've tapered down a little bit this year simply because we're also doing a startup and we're self-funding that, and we have a lot of active searches. But we know of other people that are still very active and are doing as much as before. I mean, I think there's a mix of, I don't know if you agree with that, but
The pie of known search fund investors has probably expanded by a factor of 10 in the last 2 years. There used to be 20 kind of known quantities in search fund investing, and there's now somebody harvested the websites of all the search funds about 9 months ago, and I think the number then was 160, but it's probably 200 or 250 by now. There are just plenty of investors out there, and as long as you choose them well, I think you can just ignore the shortage of capital that you're hearing about.
So Pachito traveled from San Juan, Puerto Rico, and Robert's here from Dallas, and Jim is a legal resident of New Hampshire because there's no state income tax there, so he traveled from New Hampshire. And Rich traveled down the street. That's a lot of effort that the 4 people here made to be with you today, so please, let's thank them.